Bernie Madoff wasn't your typical Wall Street villain. He didn't bark orders on a trading floor or parade around with gold chains and fast cars. He didn't scream, "Get rich quick," or lure investors with reckless risk and high-octane promises. No, he was quiet, composed, and dangerously convincing. Madoff exuded elegance. A soft-spoken financial wizard with a reassuring smile, tailored suits, and a spotless reputation. He didn't need to ask for your trust. You gave it to him freely. After all, he wasn't just another Wall Street player. He was one of the architects of modern finance, a former chairman of NASDAQ, a pioneer in electronic trading, and a revered advisor to institutions, charities, and billionaires. To the outside world, Bernie Madoff was the very definition of legitimacy. But behind that pristine image, behind the prestigious office, the polite manner, and the well-manicured illusion, was a financial predator. A man who constructed a fraud so vast, so meticulously maintained, and so morally bankrupt that it would ultimately become the largest Ponzi scheme in human history. It wasn't just money that vanished. It was trust, livelihoods, retirements, and entire futures. Madoff's scheme consumed everything, from elderly couples' savings to global charities, from hedge funds to Hollywood's elite. This isn't just a story about a con man. It's a story about how the most trusted face on Wall Street deceived the world and stole $65 billion in broad daylight over decades, and how, for years, no one stopped him. Part 1. The Rise of a Market Legend, The Humble Beginnings. Bernard Lawrence Madoff was born in 1938 in the quiet, working-class neighborhoods of Queens, New York. The son of Jewish immigrants, Madoff grew up with modest means and an outsized ambition. He didn't come from money, but from the very beginning, he seemed drawn to it like gravity. After graduating from Hofstra University and briefly attending law school, he chose a different path, one rooted in risk and independence. With a mere $5,000 saved from installing sprinkler systems, Bernie Madoff launched Bernard L. Madoff Investment Securities, LLC in 1960. What started as a small-time operation run out of a single office would eventually become the epicenter of Wall Street's greatest deception. In those early days, Madoff was the real deal. He built his business as a market maker, earning profits by matching buyers and sellers and profiting from the spread. He didn't gamble with other people's money. He facilitated trades, efficiently, ethically, and most importantly, profitably. But Madoff wasn't just making money, he was changing the game. He became one of the pioneers of electronic trading, revolutionizing the speed and precision of Wall Street transactions. He rubbed shoulders with the titans of finance, gained early access to powerful market tools, and eventually helped turn NASDAQ into a force that rivaled the New York Stock Exchange. In a sea of sharks, Madoff swam with confidence and calm. He wasn't just surviving, he was shaping the very waters around him. The man everyone trusted. By the 1980s and 90s, Madoff had become more than a financial expert. He was a living legend. His name carried weight in every boardroom and banquet hall. Institutions didn't just trust him, they sought him out. If you had money and Madoff would take it, you considered yourself lucky. His firm operated like a fortress of exclusivity. Madoff didn't advertise, he didn't pitch. If you're asked to invest, you might be rejected. That's what made him irresistible. In a world of salesmen and scammers, Bernie Madoff was the rare breed who made you feel like you needed him more than he needed you. Wealth managers, hedge funds, country clubs, and celebrities whispered his name with reverence. His client list reads like a who's who of the global elite, from Nobel laureates to Hollywood royalty. And his fund promised the one thing investors crave more than high returns: consistency. Madoff delivered what no one else could: steady profits, year after year, even when the broader market stumbled. Not enormous gains, but smooth, reliable growth. Whether the market was soaring or crashing, Bernie's numbers barely wavered. To the untrained eye, it seemed almost magical. To seasoned investors, It seemed genius. In truth, it was neither. But no one asked questions. Why would they? Madoff had the pedigree, the charm, the status, and most dangerously of all, he had their trust. For decades, the legend only grew, and so did the lie. Part 2. The mechanics of a multi-billion-dollar lie, the classic Ponzi model, but on steroids. At its core, Bernie Madoff's criminal masterpiece followed a familiar blueprint, a Ponzi scheme, one of the oldest tricks in the book. The concept is simple. Take money from new investors and use it to pay off earlier ones, creating the illusion of profit and success. It's a financial pyramid built on borrowed time. But what made Madoff's con so diabolical wasn't the idea. It was the execution. Most Ponzi schemes burn bright and crash quickly. They collapse under their weight when too many people ask for their money back. But Madoff's operation endured for decades, thriving in plain sight on Wall Street. How? Because Madoff didn't look like a con artist. He looked like the safest man in the room. His investment firm occupied multiple floors in a Manhattan skyscraper. He had hundreds of employees, many of whom worked without ever knowing the fraud next door. He projected calm, quiet confidence, not greed or arrogance. And critically, he used an obscure two-person accounting firm in a strip mall in Rockland County, New York, to audit his books. The firm, Freehling and Horowitz, was a complete sham. One elderly accountant signed off on financial statements he never actually reviewed. And yet, the illusion held. Why? Because Madoff's greatest deception wasn't in how much he promised. It was in how little. He didn't offer sky-high, unbelievable returns. He offered just enough to look impressive, 1% to 2% a month, like clockwork. Rain or shine, boom or bust. Even during financial downturns, his clients made steady gains. No volatility, no losses. This calm in the storm was precisely what made it believable. He claimed to use a sophisticated trading strategy called split strike conversion, a mix of investing in blue-chip stocks while using options to hedge the risk. It sounded complex, but plausible. It gave him an aura of elite financial mastery. But there were no blue-chip stocks, no options, no trades, no portfolio, just forged trade confirmations, fake account statements, and thousands of investors staring at computer screens filled with lies. In the back office, employees manually typed up trading reports for non-existent transactions. On paper, clients were growing richer by the day. In reality, the money wasn't being invested. It was just sitting in a Chase Manhattan bank account, waiting to be recycled to the next investor. Bernie wasn't growing wealth. He was shuffling billions around in a shell game so large that even regulators were fooled. The role of feeder funds. While many fraudsters scam individuals one at a time, Madoff supercharged his empire through a powerful weapon: feeder funds. Feeder funds are financial intermediaries, banks, hedge funds, and wealth management firms that collect money from thousands of clients and invest it collectively. To the average investor, this meant they weren't investing directly with Madoff, but they were still part of the scheme. These funds acted like high-pressure funnels, channeling billions into Madoff's hands. They gave him global reach, attracting money from Europe, South America, Asia, and the Middle East. Countries, pension funds, religious foundations, and billionaire families unknowingly became part of his web. The irony? Many feeder funds conducted zero due diligence. They never asked to see trade confirmations, audits, or even account access. Why would they? Their clients were thrilled with the consistent profits, and the fund managers were earning massive fees just for parking money with Bernie. Madoff became a kingpin of phantom profits, lauded in investor circles as a financial genius, when in reality, he was simply stealing from Peter to pay Paul. And the truly chilling part? The entire time, the money wasn't even moving through markets. It sat untouched, accumulating dust in a bank account until someone requested a withdrawal. The brilliance of Madoff's scheme wasn't just that it worked, it was that it worked so simply and for so long. Part 3. Warnings, red flags, and ignored evidence. The whistleblower who wasn't heard. In '99, a financial analyst named Harry Markopoulos figured out the scam. After analyzing Madoff's reported returns, he realized they were mathematically impossible. He went to the SEC multiple times with detailed reports titled things like, "The world's largest hedge fund is a fraud." He outlined how Madoff's supposed strategy didn't align with market activity. He showed how the returns defied logic. He even offered ways to catch him. The SEC ignored him over and over again. Why? Because Madoff was too well connected, too powerful, too polished. SEC officials even had ties to his family. The watchdog meant to protect investors instead turned a blind eye, allowing the fraud to grow larger with every year. Part 4. The Collapse. December 20, the financial crisis trigger. For years, Bernie Madoff's Ponzi scheme had survived the impossible. Market crashes, regulatory inquiries, and even skeptical whispers. But in 2008, the illusion met its match, the Great Recession. As global markets imploded and banks collapsed like dominoes, fear swept across the financial world. Billionaires and retirees alike began pulling their money from even the safest investments. Confidence, Wall Street's most valuable currency, was evaporating fast. Madoff's clients, many of whom believed they were sitting on millions in paper wealth, began calling in their chips. They wanted out. They wanted their money. They wanted to cash in on those famously steady returns before things got worse. And that's when the lie came crashing down. Madoff was suddenly hit with $7 billion in withdrawal requests, more money than he had ever faced at one time. But the truth was damning. He didn't have it, not even close. Years of lies, forged statements, and fake profits had built a towering house of cards. And now, a single gust, the global panic of 2008, had knocked it down. For the first time in decades, Bernie Madoff couldn't pay. The illusion of wealth had always depended on one thing: no one asking for it all at once. As long as money flowed in, the game could continue. But when fear replaced faith and clients demanded their cash, Madoff found himself cornered, exposed, and out of time. The confession: it's all one big lie. On the evening of December 10th, 2008, in his $7 million Manhattan penthouse, Madoff gathered his two sons, Mark and Andrew, both of whom worked at the firm, but had no knowledge of the fraud. With his empire teetering on the edge, Bernie looked them in the eyes and uttered the words that would shake the world. It's all one big lie. He admitted everything: how the investment advisory arm was a complete fabrication, how the billions in returns were made up, how the trading records were fiction, and how he had been stealing from clients for decades. Stunned, horrified, and heartbroken, his sons didn't protect him. They did what he hadn't expected. They turned him in. The arrest that rocked the world. On December 11th, 2008, Bernie Madoff was arrested by federal agents and charged with securities fraud. The news sent shockwaves through the financial world. The man once celebrated as a titan of trust had been unmasked as the greatest con artist of the century. The arrest ignited a media firestorm. Cameras swarmed the courthouse. Victims flooded hotlines. Journalists, regulators, and lawmakers scrambled to understand how a $65 billion fraud had unfolded right under the noses of America's financial institutions. Wall Street wasn't just shaken, it was shattered. This wasn't just a scandal, it was a betrayal of unprecedented scale. Part 5. The Fallout. Broken lives, lost fortunes. Who were the victims? Retirees who lost everything, charities that had to shut down, schools, hospitals, and religious organizations that had placed trust in a safe investment, celebrities like Kevin Bacon, Steven Spielberg, and Zsa Zsa Gabor. Billionaire families, including the owners of the New York Mets. $65 billion. But what was lost? The $65 billion figure includes fake profits, meaning the real investor loss was closer to $18 billion. Still massive, but not every dollar was real. Most of it was phantom wealth, created on fake account statements. Part 6. The aftermath, prison, payouts, and public rage. In 2009, Bernie Madoff pleaded guilty to 11 federal felonies. He was sentenced to 150 years in prison, the maximum possible. He died in prison in 2021 at the age of 82. The trustees fight for justice. Irving Picard, the court-appointed trustee, spent years recovering funds. Through clawback lawsuits and asset liquidations, he was able to return over $14 billion to defrauded investors, an unprecedented recovery. Part 7. The legacy, how Madoff changed the world. Madoff didn't just con investors, he exposed the fragility of trust itself. He showed how institutions designed to protect the public could fail when seduced by prestige. In response to the scandal, his story serves as a cautionary tale, not just for Wall Street, but for anyone who's ever looked at a too-perfect opportunity and hoped it was real. Because sometimes, the man in the nicest suit is the one who'll rob you blind with a smile.